Hey everyone, today we're going to do a quick overview of Libor, which is the London interbank offered rate. And it's been in the news a lot over the last few years. It is used extensively in financial markets, especially in the fixed income world. It's kind of important. It's going to be, I guess, becoming more important for the future concepts that we introduce. But I just thought I'd take a small detour to sidestep and just introduce something that's actually giving you hopefully some context about a term that you may have heard a lot in the news and might be curious about. Okay, so let's get started. Okay, guys. So I've got some notes here. I'm going to go through, demo a few websites and stuff to explain what this Libor thing's all about. As we know, it stands for the London Interbank Offered Rate. And the first thing I want to do is to kind of correct what I think is a common misconception about how Libor is used and what it is. Now, somewhere you'll read Libor is the rate at which banks lend to each other on the interbank market. And that's actually not strictly true. So I'm going to go into a formal definition of what this thing actually is, right? The London Interbank Offered Rate. So as most of us, we're familiar with the concept of banks. Okay, a bank is an organization that traditionally, on the high street at least, takes deposits from ordinary folks like you and me, keeps them in a bank account, and then lends that money out to mortgage holders, small businesses, whoever else in society wants to borrow money. So common names like Barclays, HSBC, RBS are all involved in this kind of activities. But there are other sides to banking, other branches, other arms to these big banks, especially around kind of investment and trading activities. Okay, so for example, Barclays will have their own trading desk who trade in various securities on the financial markets in order to boost their own profit. And then also the investment banking arms of these institutions will be working with clients to issue new bonds, not trades, new bonds to raise capital through new share issuances, and even to help companies merge or acquire other companies. So these banks do a lot of different things, but one of the core requirements for banks, right, is their reserve requirements. Okay, so banks, in order to meet their obligations, their short-term obligations, which is to satisfy let's say a reasonable risk in terms of the exposure and the number of people coming and knocking on the door asking for their money on a daily basis, they have to meet these reserve requirements, right? Which means that they have to have a certain amount of cash on reserve, so that if their clients, people like you and me, for example, withdrawing all our money out of the ATM, they'll have enough money not to satisfy all the customers, all the clients withdrawing the money at once. That's called a run on the bank, and we all know what happens if that actually occurs. But the reserves at least mitigate and prepare the banks for let's say a sensible amount of liability to pay out cash on a daily basis. So with these reserve requirements in mind, the banks on a daily basis, these guys like Barclays, HSBC, RBS, please excuse my handwriting, they're all evaluating how much cash has gone out the door today, how exposed they are they below or close to their reserve requirements, and if so, they will need to borrow short-term funds, right, to actually fill the gap, and so that they meet their reserve requirements, so they have enough cash basically on hand to satisfy their reserve requirements. So that's what the London the interbank market, right? It's a very common term, the interbank market, and this is the market where banks like Barclays, HSBC, RBS, and a whole load of other ones lend money to each other to fulfill their short-term obligations, right? That's the interbank market. Now, so what Libor is it's an average estimate of a sample of up to 18 banks, okay, depending on certain things which we'll go into. But let's say a pool of banks in the interbank market, estimating how much it would cost them if they were to go into the market today, okay, just before 11 a.m. in the morning London time, and request to borrow money from the other institutions, let's take Barclays for example, if it were to ask to borrow money from the other institutions, how much would it cost in terms of the interest rate that would be charged by these other institutions, right? It's an estimate of that. It's not what those banks are currently prepared to lend to other banks. It is what they think they would be charged if they were to borrow, right? That's a very common misconception, okay? So Libor is basically it's calculated, it's calculated and estimated in 5 different currencies down here, right? So US dollar, euro, GBP, Japanese yen, and Swiss franc. It used to be more, but recently it's been kind of pared down to fewer currencies, okay? And so what that means is that the banks have to submit this estimate on how much it's going to cost them to borrow this money. If these loans, these hypothetical loans, were in each of these currencies, right? So they each submit 5 different currency, right? 5 rates for each, so one for each currency, but also for the following maturities, right? So these are the currencies down here: US dollar, euro, GBP, Japanese yen, and Swiss franc, okay? And they have to submit what interest rate they think they would be charged, okay, to borrow money for the following amounts of time: 1 day, 1 week, 1 month, 2 months, 3 months, 6 months, and 12 months, right? And so that enables us to calculate an average for each currency for each time period across the banks, right? And then the result is the Libor for that particular combination of currency and time period. There's one slight correction there, which is that it's not just the average of all the contributions. In the case of USD Libor, there are 18 participants that you can see up here, right? So some of the names will be familiar: HSBC, Bank of Tokyo, Lloyd's, Royal Bank of Scotland, Barclays. So very familiar names. So there are 18 contributors for US dollar Libor. What the calculation agents do when they receive these contributions from the banks is they will take the bottom 2 and the top 2 and throw them away and take the average of the remaining 14, right? This is just for US dollar Libor. The participants, the contributors for the different currencies, Euro, GBP, Japanese yen, and Swiss franc, are slightly different, right? So there's a different set of contributors for each currency. Okay, one important thing that I want to show you is basically how you can actually see these rates, right? So if you go to this website, I'll put the link down below here, and you can actually look up the actual rates that have been published on a daily basis for any date, right? So you can go back. It goes back 2 business days. For example, today's Sunday, the 4th of September. I can see the most recent report I can see is for Thursday, the 1st of September, right? So I can pick 1st of September, and then here you can see the 5 currencies that Libor is calculated for. Okay, so we're going to pick USD, right? Because we're talking about USD Libor, which is obviously it's the rate at which these London banks are estimating they would be able to borrow US dollars just before 11 a.m. on the 1st of September 2016, right? And you can go and see it for any day, right? So if I submit this, okay, so here we can see for US dollar, we can see our 7 maturities, our 7 time periods, right? So what they're saying is that these were the rates that calculated for the 1st of September, right? So an overnight loan on average was estimated at 0.41611% annually, right? So you're not paying 0.4% on the actual balance of the loan overnight, right? That has to be this is an annualized percentage. I'll show an example in a second. And then, as you can see, as the time period continues, and we'll go into this more when we look at yield curves in later videos, but you can see that the interest rate to borrow money for a whole year on the interbank market has been estimated on average the banks have estimated on average that it would cost them 1.56556%. Okay, so that's an example of some actual rates, and it's really useful, I think. There's lots of good information on this website here about the participants in the LIBOR, so the people who contribute, all that good stuff like that. So one point I wanted to make was that the rates quoted that we saw on the website are annualized, right? So if, for example, so we saw our one day rate was 0.41611%, right? That was our USD 1 day LIBOR for the for the 1st of September. My apologies. 1st of September. Right. So that was 0.41611%, and then the 1 year rate, right? USD 1 year LIBOR for the same date was 1.225122%. Okay, so what that really means, just as I said, is that if the bank was, say, borrowing $1 million, right, and in practice the amounts would be far higher than this, but if the bank was borrowing $1 million for 1 year, right, then the amount of actual interest they would pay at the end of that year would be basically 1.225122% of that, right? So it would be basically this. For the 1 day rate, we saw, as I said, the annualized rate was 0.41611%. Okay, but so for a 1 day, so basically an overnight loan, just to borrow those funds overnight for 1 day, would basically same amount would be 0.4161 divided by 365, right? So the actual dollar amount would be, so it'd be approximately £1,140, right? So that's the actual amount of interest, right, on 1 day loan, right? So it's important to realize that the rates are all quoted on an annualized basis, even though the loans themselves apply to 1 month or 1 week or 1 day time periods. Okay, so that's basically a little bit about sort of how LIBOR is calculated, how it's reported, how you can actually go and see what the rate is on a daily basis. But I think I want to sort of really touch on how LIBOR is actually used and what it's used for. So as I mentioned at the beginning of the video, it's important to realize LIBOR is not used by definition as the rate at which banks are forced to lend or borrow money from each other, right? So it's just an index, it's just a benchmark, it's just an average daily submission based on the bank's best estimates on an honesty basis, right, on how much it would cost them to borrow money from each other. But it is used extensively as an economic indicator, right? So when LIBOR spikes, for example, when LIBOR goes up, and banks are basically saying it's costing them more to borrow money from each other to fulfill their overnight obligations, that's often a sign that things are not very healthy in the banking system overall, which itself is often a sign that things are not very healthy in the overall economic system. So it's used heavily as an economic indicator. I think, as importantly, and this is really, this is kind of the incredible thing really, is that it's used as a benchmark for hundreds of trillions of loans, so corporate loans and derivatives, but also residential mortgages in the United States. So I'll give you an example here. Right? I've just sort of sketched out a very crude example down here. So let's say we've got this guy over in the US, John Doe, and he's got his house over here, right? And he has a mortgage, which is basically one of those floating rate mortgages, right? So a floating rate mortgage means that the interest rate you pay resets periodically, right? For example, let's say in this example, let's say this one resets every 3 months. This guy's mortgage resets every 3 months, and the interest rate that you pay resets and is recalculated each time, and it's recalculated based on a benchmark. So let's say USD 3 month LIBOR plus a margin, right? Now the margin stays fixed, but the benchmark, in this case USD 3-month Libor, that is obviously, as we've seen, that's a number that's quoted and changes every day. And what happens is this rate is sampled. So every 3 months, the latest 3-month USD Libor rate would be sampled, right? So you could look it up on that website there. It would be basically used. It would be added to the fixed margin to get the actual rate that this guy John Doe is going to pay on his mortgage. So now you can start to see how significant it is for people who are really not involved in finance in a professional capacity. They're just normal people who are mortgage holders, for example. And what we can see is that the submissions that these banks are giving to calculate this number are actually having a material effect in a direct way on the amount of money that John Doe is paying on his mortgage, right? Because let's say on the say 2 days before the John Doe's mortgage is reset for the next 3 months, let's say Libor, the submissions are generally they're much lower, right? So the banks have submitted a much lower estimate of their borrowing costs. That means that John Doe's mortgage for the next 3 months is going to be much cheaper, right? Because they're going to be using a much smaller value of this, right, added to the margin. We looked at the Libor rates for the 1st of September, and the 3-month rate was 0.835%. So in this particular example, right, so if you if the fixing, right, so the benchmark was 0.00835 and the margin was 0.001, then basically what that means is that John Doe's total mortgage rate would be 0.935%, right? So that's the concept of the sort of how Libor affects the actual rate that normal people, especially in the US, will be paying on their mortgage payments, right? So, but I alluded to the fact that the other thing that Libor is directly used for. When I say directly, I mean contractually used for. It's used in a lot of financial trades like forward rate agreements, interest rate swaps, and a whole load of other types of instruments, right? But the point is, there are market participants out there doing trades with each other, right? Where let's say the amount of money that the participants in that trade will win or lose massively depends on what the actual rate of Libor is on a given day, right? And the point is that the banks that we talked about earlier, they are very heavily engaged in trading of these instruments, right? So I don't know if alarm bells are starting to ring yet, okay? But you've got this situation where banks are being asked to basically submit and choose their own submissions, their own estimates of what their borrowing costs from other banks would be. Those are averaged together to form a composite, and that in turn can have a massive bearing on the outcome of these particular trading activities that the very same banks are involved in, right? So this leads me on to talk a little bit about the famous Libor scandal, right? I'm not going to go into too much detail about the Libor scandal. There's a lot of I'll put some links below. There's a lot of literature about it, which is goes into the details of who was guilty and and who went to prison, etc., etc. But in general, the Libor scandal was all about the fact that certain banks, in that list that I showed you earlier, certain banks were found guilty of basically manipulating their submissions for the Libor calculation, right? So we've already mentioned sort of two potential, well, one main potential reason why banks would want to manipulate and falsely report the estimate of their borrowing costs, which would be that the trading desks within the same banks have told them, listen, we are massively exposed to Libor. We're involved in such and such a trade, right? And the bank stands to win or lose a massive amount of money depending on what you submit, right? So that was one motivation for the trading desks of these banks actually persuading the submitter to submit a let's say a distorted version of what the bank's actual borrowing costs were. But the other main motivation comes, and again, when I first heard about this, I found it very strange. I have to admit that asking a bank to report their borrowing costs is kind of, they're kind of exposing their credit worthiness, right? When they do that, the banking system as a whole, they really depend on their credit worthiness, right? Because banks are in the business of borrowing money all the time from each other. They also lend money too, but banks, in times of crisis, were sort of incentivized to basically, or disincentivized to report high borrowing costs because it made them look relatively weak compared to other banks. So there was always this undercurrent as well, that banks, that there was pressure on banks to sort of submit let's say a lower borrowing cost than might be accurate, right? So basically, what happened? There was this big scandal went out, and people, the criminal prosecutions happened, and huge fines applied to certain banks. I'm not going to name any names here. You can look it up. But in a nutshell, what happens is that they decided, okay, so we need some reforms, right? So we need to actually look at the way this whole thing works. I'm sorry, these notes are very scrappy, but the top guy at the FSA, this guy called Martin Wheatley, he was asked to sort of compile a report of recommendations to the UK government on how to basically overhaul the system. And I think so. Two of the main things that came out of it that I think are worth talking about are that the recommendation was that the actual individual submissions are actually exposed after 3 months, right? Now the reason why it was after 3 months is because going back to the idea of let's say in times of crisis, let's say that all the individual submissions were being made public on the very same day, right? Then the bank would be heavily disincentivized to publish an accurate high borrowing cost, and in fact it would be incentivized to sort of reduce its estimate to make itself look less vulnerable and try and paint a rosier picture of itself. But because their submissions won't in any case be public until 3 months' time, the hope is that any short-term crisis by then will be will be past, and therefore the banks have no motivation whatsoever to submit distorted individual submissions. Okay, and the other one that came through is that they wanted the banks to basically provide their submissions as as much as possible based on actual transactions that have happened. So actual loans that they're either in the process of taking out or that they've recently taken out. Right now, this can obviously only be done on a best efforts basis, because if you look, the maturities here for Libor, as we saw, were 1 day, 1 week, 1 month, 2 month, 3 month, 6 month, and 1 year. Now, generally in the interbank market, the banks generally tend to be borrowing for the sort of the shorter time frames, and the longer time frames like 6 months to 1 year, it's slightly rarer. So there won't always be examples that a bank can sort of fall back on to say, okay, well, we recently borrowed for 1 year from JP Morgan, and this was the rate, right? So but on a best efforts basis, because these submissions are now going to be transparent, the pressure is on the banks now to sort of really be able to justify their submissions, right? So that's really sort of all I want to say about Libor for now. If there's one takeaway about it, it is basically that Libor is not contractually the rate at which banks borrow and lend to each other, as in not necessarily. It is an average of what each of a pool of selected banks for a combination of different currencies and time periods, what they believe it will cost them to borrow those currencies for that time period, right? It's an average of those, with the bottom two and the top two cleaned out. It's published every morning at shortly after 11 a.m. London time, and you've got the link down there to see what the rates are, and then it is used contractually, that is, for a whole host of other financial instruments like corporate loans, mortgages, floating rate mortgages, and derivative trades like forward rate agreements, interest rate swaps, and all that kind of stuff. I'll be going into them in future videos. If you have any questions about this or any feedback, please leave it down below. I hope it was of some use. We will be coming back to this Libor concept in more depth later when we start talking about yield curves and also, as I mentioned, the forward rate agreements and interest rate swaps tutorials we'll be doing later in the series. So thank you for watching, and I will see you in the next video.